Welcome to the Page One Podcast, a twice-weekly podcast featuring a variety of guests and thought leaders on topics ranging from channel strategies to tariffs, influencer marketing, best-in-class product launches, and all the details about how to accelerate your e-commerce sales with the big box retailers, or what we call R-commerce. Now here's your host, Luke Peters.
Thanks for joining us on the Page One Podcast. I'm your host, Luke Peters, and this is the podcast where I bring you the best and brightest leaders to share consumer product sales and marketing strategies that'll help you grow your business. I'm the CEO and founder of Newer Appliances, where I cut my teeth selling products online, and now I've started Retail Band, where I hope to help other brands succeed in product launches, influencer marketing, and B2B online sales strategy. And right now, I'm offering a free evaluation of your online sales strategy. If you're interested, find me on LinkedIn or go to luke@retailband.com to learn more. And in this episode, we're going to learn from Mark Thomann. Mark is an entrepreneur and venture capitalist. And in this special episode, you're going to learn Mark's strategies for investing in and growing dormant brands. So personally, and for a lot of my friends, have you ever wanted to grow your company by acquisition? If that's a question or a strategy that you might have, then this is your episode. Mark is a venturepreneur, a term he recently coined to describe his background as an entrepreneur and a venture capitalist. Mark has a history of reimagining and relaunching iconic brands. As the founder of Dormitus Brands, he recently founded an early-stage health and wellness fund called Spiral Sun Ventures. Mark attended the College of Holy Cross. Mark, thanks for joining me today on the Page One Podcast.
Thank you, Luke.
Cool. And we were just talking about the Chicago weather. Mark lives in Chicago, married, 3 kids, and it sounds like the weather's good. And we're just talking about the Housewares show coming up in a couple weeks. So we're recording this on the first Monday of March. And Mark, before we kind of get into it, why don't you fill in any gaps and kind of explain a little bit about what Spiral Sun Ventures does?
Sure. So for many, many years, I was really acquiring trademarks and patents and had always had this fascination with intellectual property and started acquiring dormant trademarks and then relaunching companies around them. And then about a little over 8 years ago, I had a health scare, and it really had an impact on sort of how I wanted to spend my time and money and resources. It was a little bit more than a scare. It was a reality check that I had to really, change my lifestyle, eat healthier, exercise, and I wanted to be around, spend more time with my family and young kids. And so about 4 years ago, and by the way, everything is good now. I did change my lifestyle, but I started blaming sort of my sickness to the way I was eating my lifestyle, and in particular processed foods. So about 4 years ago, I decided to co-found and launch a venture capital fund that invests in early stage food companies. And I thought that my experience and my contacts and my my relationships with retailers and so forth could really help these young entrepreneurs kind of figure out how to scale their businesses. And so Spiral Sun was formed, and since that time, we've raised significant amounts of capital to invest in some pre-revenue companies, in companies that continue to grow. But we invested in approximately 15 companies in our first fund, and we continue to invest in early stage health and wellness companies more broadly than food in our opportunity fund in our second fund. So for me, it's been a wonderful experience, not only as a venture capitalist, but more importantly, just mentoring these entrepreneurs and how to better scale their businesses and how to take my experiences and relationships and ultimately allow for these businesses to scale more quickly.
Great. That filled in all the blanks, and definitely we're going to dig right into that. And for the listeners of this podcast, a lot of brand owners, hopefully we'll give you guys some real actionable tips on maybe how to acquire companies or how to use that in a way to grow your existing brand, but also what Mark does within side of these brands, these dormant brands or these small companies, and how he grows it. But Mark, before we get to that, I just thought that was interesting, and it seems like a life-changing event in the health scare. And a lot of people don't want to have to change they don't want that to happen to have to change their lives. And you hear about, people, how they were living before and then how they lived after. And I guess, so you could maybe share some wisdom on that. Like, did you totally change your work-life balance? Was it more just around diet? Or I'm just curious, if you could just say, how things look before and after and pass on that wisdom to the audience.
Sure. I think really prior to the sickness, I was really focused on all the wrong things. I worked a little too hard, was eating improperly, mainly because of the fact that I was working virtually most of the day and was not prioritizing, spending the quality time with the family the way I should have been doing. And when I did get sick, it really repositioned how I thought of not only my way of life prior to that, but how I wanted to move forward. And so, yes, I stopped eating the sugary snacks, and I stopped, trying to continuously, work around the clock while ignoring the more important things in life. And so for me, my aha moment was, how can I take what I've, the career that I've built and have an impact and a legacy? And at that time, I decided to invest in at the time, the largest indoor farm that was producing leafy greens in America. And I did that. It was more of a restructuring opportunity where the company was, virtually failing. And I came in and utilized some of my background as a turnaround specialist and helped bring that company to a point where it survived, and it survived today, but had to dramatically pivot that business. But for me personally, it really became the catalyst for how I wanted to really spend my time. And then I was able to also look at dormant brands that I had acquired, or we had acquired as a company, and reposition them as health and wellness products. So if you look at Spiral Sun today, it's really the integration of my previous work as well as finding new entrepreneurs and new products. But there are two dormant brands in our portfolio that I've repositioned in a much healthier way than what they were in the first run.
Yep. Okay, cool. Makes a lot of sense. And let's get rid of the sugar. I've done some of that. Personally, and I found it makes a big difference, and stopped eating bread and stuff like that. But yeah, definitely huge proponent of eating healthy, whole foods when possible. So sounds like it made a big difference for you.
Made a big difference, and I still struggle with it. It's not easy to eat healthy, but I certainly do my best, and certainly continue to invest in companies that promote that.
Yeah, and what's funny is, just on a tangent, is like I might have like the same path in some ways, or same interest as you, because I am really passionate about healthy food. It's like, but sometimes you're caught up in your own business and your own life, and it's hard to find that just that exit velocity, to get out of your own way. Like, you have to, there's so many things to write on your own ship before you can move on to that other thing. But yeah, no, I'm really jealous actually that you've been able to do this. But I have a lot of thoughts on it. And just kind of to your question or point right there, it is difficult. And what I found is the power of habit. Like, if you can just say, okay, I'm just literally not going to do this. And then that kind of will define your other choices, So for folks, like, even if someone's not gluten intolerant and they're like, well, you know what, it's not a matter of that only, but just the fact that, these types of carbs overall aren't great. And someone just says, I'm just not going to eat bread, then that one habit can have like a huge, effect. It'll roll down through a bunch of other decisions that you make. So not here to preach about diet, but it's something that I found works pretty good. And anyways, thought that was very cool that had an impact on your life. So Mark, why don't we talk about when you're looking at these companies? And I guess my first question is kind of a big one, and that is, I just kind of want to understand your system, because you did bring up an interesting nuance that I didn't know, that you're a turnaround specialist. So I actually kind of wrote down another question on that. But, do you have a system? How do you repeatedly successfully invest in and build these brands?
It's a really great question. I do think my turnaround background I was doing restructuring work for over 10 years, and I was primarily selling distressed companies. And that really trained me to look for, the fundamental flaws in why a business didn't work or why a brand failed. And so I utilized that skill set and really look at things with a very critical eye today, mainly because of that background, which was really industry agnostic, where if you really know what made a company fail, you're much better equipped at understanding how to make it succeed. And so, for me, when I look at, my own brand portfolio as well as these early stage companies that are trying to build a brand, it truly is about people. And I know everyone talks about that, but, we have incredible entrepreneurs in our portfolio, but they need help. Not everyone can do everything. In early stage companies, the biggest problem is if you look at a lot of venture funds, they really can't roll up their sleeves, and they provide capital, but there's not a whole lot more value, right? So the premise that we went in with Spiral Sun Ventures is how can we truly not only invest our capital, but how can we bring human capital to bear to really impact these companies in a small way. And how do we do it? We have an ecosystem that we created of people that everyone from retailers to marketing agencies, and they all have to go in understanding that number one, that this isn't a Fortune 500 CPG company. These are young entrepreneurs that have, identified a white space primarily in food and beverage, but in health and wellness in general. And how do you move the needle to help them where they can build a brand that has enough critical mass that one of the larger CPG companies is going to look at acquiring them? And then, obviously, a lot of times the big CPG companies just can't figure out, how they want to invest their money in new categories and new products. And a lot of these early stage companies, they're doing all the heavy lifting. But at the end of the day, it really is about exiting to the bigger companies that have the infrastructure to take it to the next level. You can only, like in beverage in particular, if you don't have the DSD network and you're highly dependent upon all the distributors, it's very, very difficult to get beyond $100 million. And you really need the Pepsis, the Cokes, the beer companies to ultimately take it to a point where you can go from a $100 million beverage company to something far greater than that. And so I try to instill that into the thinking of every young entrepreneur that's in our portfolio, that this is really, really tough to go from $1 million in revenue to $100 million plus in revenue. And ultimately, you need the resources and the infrastructure that some of the big CPG companies have. And in order to get there, you have to figure out a mix between bringing in advisors that have that big CPG experience, as well as, remaining, gritty and entrepreneurial, because that's one of the missing elements to some of these big CPG companies. Hope I answered your question, Luke.
No, definitely. And I have a couple more to jump in. And I like that you mentioned white space. I mean, it's funny because we're doing our planning and that's a key term, instead of out competing, but finding the white space. So is it mainly a function? So when these companies come in and they have a great idea and maybe they might even have their mission or purpose, but is success early on, let's say first 5-10 million, is that mainly dependent on marketing, would you say?
Yeah. I grew up in Boston, actually. So I'm still a Bostonian at heart. And years ago, I'm kind of giving away some of my age here, but years ago we had a politician by the name of Tip O'Neill. Most of us will remember Tip O'Neill, but he said something that was really telling. It's a quote that stayed with me for all these years, but he said, all politics are local. At the end of the day, that adage applies to brands and brand building. And these young brands that are going into categories that are still growing and expanding, you need to build communities, and they really do start in a very local way, and then they gain momentum, and they continue to gain momentum by getting into significant distribution, but also figuring out how to get those velocity numbers. And a lot of times these entrepreneurs, some within my portfolio, they're so focused on trying to get on shelf. What they don't realize is that, the question they should be asking themselves is not really how they get on shelf, but why something's coming off shelf to make room for them. And if they approach it that way, they'll have a much better chance for success, because they'll know, why this other company may have failed or why a certain SKU failed from that other company and why the retailer is making space for them. And then they have to build the community and the awareness, that is necessary in order to generate that buzz to move the product on shelf. And you had mentioned early on in this podcast that you show people how to build their e-commerce business and direct-to-consumer business. That's an incredibly powerful tool today. And we specifically look for businesses where you have that direct-to-consumer business because you have tremendous amounts of data. And the retail landscape has changed tremendously over the last 10 years. And, I think all brands should be really focused on understanding the consumer and how to articulate why they meet a need. And online marketing and e-commerce really allows you to do that where it didn't in the past.
Yeah. And what's so interesting about that answer is, of course, remember Tip O'Neill, we're reading about him, and great quote that you brought up there. But what I thought was really interesting about that was, the more things change, the more they stay the same, because, you going back to quote he said, and then you're mentioning how important it is to build communities in a local way. But it's so funny how so many modern day books will be talking about that in a way that it's a new idea, but it's not a new idea. Like you're bringing up, it's always been an idea. And now it's just framed in a different way, where folks will write about that you have to build a tribe. And but I couldn't agree with you more, though. It's a great point. Build a community. We can all do better at doing that. Actually, we're just launching a beer cooler and beer enthusiasts, and so I'm just taking notes on that. And how can we better build a community around that? We're already doing a good job, but it's just a great point and a great reminder.
Like for example, Luke, our most recent investment, and I'm only picking them because we just did it last week, but we just invested in a pet food company that focuses on the keto diet for dogs.
Oh, wow. And
it's a community. It's right now, it's just a direct-to-consumer business. It's called Keto Natural. And the founder has not only written books on the keto diet, but he had a very compelling business plan. But he built the business first, direct to consumer, because he really wasn't ready to go on retail shelves. And ultimately, he needed to be prepared and understand, who his consumer was, and he built that community around his product online. And the next step is to take it to more traditional retail. But there's a tremendous education that goes along with that product. And how do you best do it? You use the tools that are easiest and I don't want to say cheapest, but certainly most productive in building those communities. So, and I'm not an expert on online direct-to-consumer businesses. My strength is really in traditional, conventional retail. But I look at those numbers and have people around me that understand it and do a better job than I do.
Yeah, and that's a good example. And it's funny. These are all the things I read up. So I know a lot about keto. And one reason why that's a great idea or a great product idea is because people are really passionate about keto, when they're involved in it. So there'll definitely be some education for that investment of yours. But at the same time, they've got a really passionate, engaged audience. When people believe in keto, it becomes a lifestyle essentially. So yeah, that's, and then, super niche as well. So that is a good example. Speaking of those investments, what is like the range of your investment size? Is that something that you can talk about? And
sure. Yeah, no problem.
Is it usually like a minority investment? These are like Series A. Like, how does the typical investment look like?
It's across the board. The Keto Natural deal we just did and closed. We did it with another fund here in Chicago called Corazon, and it was great because they're much more focused on direct-to-consumer subscription model businesses, and having them kind of leading that due diligence was excellent. But in general, we like to deploy, $250,000 to $500,000. Sometimes we'll do lower, sometimes we'll do higher. Pacha soap, for example, which is becoming a household name in the natural channel. We deployed, a few $1 million into that company, but we've watched that grow from significantly over the last 4 years, seen probably 10x on growth since we've on top line revenue since we made that investment. But generally, it's 250 to 500, but we want a reason to put more in. and to continue investing in the companies that we've picked to be part of our portfolio.
Great. And that's usually for some sort of like is Series A typically, is that like a 30% stake in the business? I'm not hugely knowledgeable about.
Yeah, could be a little less than that, but we come in so early because there's really a void in the market space. You know, there's especially in Chicago, there's really not a whole lot of seed funds here, especially in health and wellness or food and beverage. You certainly see it in tech. With, you know, food and beverage in particular, again, I'm a kid from Boston, so I use an analogy. I think we need a Ted Williams average in food and beverage.
Yeah.
And so it's really, really important to mitigate risk and to, come in at valuations that make sense. But if we're going to come in and the entrepreneur is going to give us a good valuation, they want to see us really help them move the needle. And so we try to practice what we preach. It's funny, part of our due diligence process, we have to get references from all of our entrepreneurs, founders. I tell each of them to do the same on us. Call our portfolio companies and ask them if we add value. And if we don't, it's probably not a good match.
Wow. And then when you come in, so I think at the beginning you mentioned, I mean, it's a relatively new fund. Is the idea to, exit in 5 years? And if so, how many exits have you guys had the chance to go through?
Yeah, we're 3 years in, and our opportunity fund and our second fund are just, you really just got a kickstart this year. So we're still very, very early in our life. We probably have a longer life cycle than most early stage venture firms, is simply because we're investing so early, and these companies take a long time to mature. But we have yet to have a traditional exit, but we've seen growth in every one of our portfolio companies, and certainly see exits in a number of them. Farmer's Fridge, for example, was a concept that I was the founder's first board advisor and one of his first investors, and we've seen that company grow immeasurably, from a small kiosk-based salad business to one that's now in major cities throughout the United States. We've seen, when we first invested, it was a very small amount of money, and we've seen, $30-40 million being invested into that company over the last couple of years. And it's wonderful to see, but the key premise for me when I look at investing in a company, and our fund looks at investing in a company, is we have to be able to help. But the other thing that I love is when I no longer have to spend hours upon hours a week helping these companies because they've already figured it out. And so we have companies in our portfolio that no longer really require a lot of my time. And that to me is a win. But we'll see exits in our first fund over the next year and a half to 2 years. Yeah,
well, and you mentioned they're all growing. That's a much higher. That's more than a Ted Williams average right there. So you guys you're doing something right.
Oh, yeah, we are, but we're not. They're not all going to make it.
Yeah, I gotcha.
So we realize that, but we certainly have. We've really helped a lot of them along, and it's not only our fund. We bring in a tremendous amount of advisors that. Either our LPs or are part of our advisory board, who have different expertise, and they've been equally as impactful on these companies. So it's not only about us; it's about our LPs and the folks that come in and really help these companies with branding in particular. I think that was one of your questions early on. It really is about marketing. We're very good at getting into distribution, but the key is, how do you build a brand? How do you build a community? And how do you get people to continue to buy that product?
Yep. Lifetime value. And Mark, kind of before going on though, I wanted to get, because you mentioned, some of these brands, obviously you're there to help and you're putting your time in. And then sometimes, they reach escape velocity and you don't need to help them anymore. They figured it out. And I want to dive more into what that help looks like. But maybe we can use a specifically, because this would be great for the audience as well. I mean, you were a turnaround specialist. You mentioned for 10 years, I guess, maybe not anecdotally, but just from what I've seen or heard, turnaround specialists will come in, they'll, find a bunch of expenses that should have been cut, but weren't. And they'll cut those expenses, and then they'll look at, sales channels and profitability per customer and get rid of the bad customers. Is it like that, or is it more than that? And what are the specifics? Because I think that would be really interesting to kind of hear, your philosophy and exactly kind of what you did, maybe with as an example of a company.
Yeah, with the early stage companies within our portfolio, it's more guidance on how to avoid, bloating and hiring folks that are gonna cost hundreds of thousands of dollars. It's really about knowing who you are and then avoiding some of the pitfalls that a lot of companies experience when they grow. And every one of them experiences it. Probably our most successful company within our first portfolio is a company called Pacha Soap. I mentioned that earlier. Pacha is that it's a beautiful brand of soap that you see in every Whole Foods. Usually it's displayed on the table and it has salts, and when you go in, you see and you smell the beautiful Pacha soap displays. And we have stores within the store in a number of Whole Foods locations, and they're continuously, expanding beyond Whole Foods. But, if you look at the challenge of that company, I can describe the soap, but most people don't know the brand, and more people don't know the mission behind the company. And so what the company really needs to start doing and is doing at this point is they've really started building their direct-to-consumer business. But now it's about brand building. They've reached a critical mass in their maturation where, they have significant revenue, significant growth, significant distribution, great retail partners like Whole Foods. And now it's about Pacha soap becoming a household name. And so how do you do that? How do you build those communities? How do you get out the message that, Pacha soap may be more expensive, but lasts a lot longer? And oh, by the way, we've taught many Africans and South Americans how to make soap and sell soap and distill essential oils, and provide a tremendous amount of money to their local economies to do so. And we also are digging wells throughout most of these communities in the third world to help to also not only educate on the importance of cleanliness, but how you can create these micro businesses. Incredible company, incredible founder, incredible product, but their challenge right now is how do you build the brand? And so that's what they're trying to do at this time. But a lot of that has to do with the direct-to-consumer e-commerce business.
Yeah, and I was going to ask, what's been your most gratifying brand relaunch? Would it be Pacha Soap, or is there another example of well, and I guess maybe that's not a brand relaunch, but I know that's part of your portfolio.
Yeah, that's not a relaunch. I'm hoping it is never a relaunch. But I would say within our portfolio is a brand called Slice, and your viewership will probably remember Slice Soda. It was a former PepsiCo brand that was back in 1987, a little over $1 billion in revenue. In gross revenue. We acquired the rights to the brand a number of years ago. If you recall, or if anyone remembers, the orange slice or lemon lime slice, it had about 55 grams of sugar in it.
Wow.
But it also had 10% real fruit juice. And that was really the reason to believe on that brand. Mm-hmm. It was the first soda to actually have real juice included. And, great growth story, and then ultimately it was discontinued and renamed Sierra Mist, which most people will probably know that brand. We acquired the rights to the brand, and we repositioned it as a better-for-you sparkling water. So we no longer have any sugar added to the beverage. The current product line has 25 calories only from the juice, and some 5 to 7 grams of sugar from the juice. So it's not added. The most, in the next few months, we're also releasing the 2 iconic flavors, the orange and the lemon lime. And it looks like those are actually going to have even less sugar and have less calories. So we're really excited about it. And we know that the consumer that we're kind of targeting is more the baby boomer. If you look at the brand awareness, it's the baby boomers and the Gen Xers has about a 90% brand awareness overall, aided. And if you look at that demographic, 1 out of every 2 baby boomer Gen Xers is looking to reduce sugar in their diet. So it's perfectly positioned to be the drink that allows that demographic to stop drinking soda and find something a little sweeter on the marketplace. When I say a little sweeter than LaCroix and the Spindrifts that are currently on the market. that aren't don't have as much sweetness from the formulations. But that's one that I'm very proud of. The product that we created delivers on that promise, and we look to have this brand, north of 100 million in the next few years, and then hopefully exit.
Wow, We
do have a CEO though, Luke, that we're not happy with. He needs to be replaced. So we do look for, sometimes when you don't have the right management team, you look for talent, and so we are looking for someone to help run that business. The CEO, by the way, is me.
I was going to say, well, this is going to be an interesting episode here.
So, but yeah, we do look for, I'm pretty good at building things and creating the foundation, and then ultimately handing it off to someone that has real, beverage experience and understands how to scale those types of businesses.
Yeah. And by the way, I usually don't get into what I do in my personal life on this podcast, but I will say that I think that's an incredible beverage idea right there, because I actually think you're going to get more than just baby boomer. You're going to get Gen X, you're going to get millennials, because the thing is, when people drink like a LaCroix, like whenever I look at these things, I just drink water, because I'm like, why do I want to put a Coke into my body? So I don't drink that. And then sparkling water's fine. But then LaCroix, I think, well, I don't know what are they putting in there to make it taste the way it is? I don't know how natural it is. Like, I don't want to drink that. But with, I always wondered why sparkling drinks don't just add a little bit of juice. The consumer doesn't need 45 grams of sugar, 5 or 10 grams of natural sugar with a little bit of actually real flavor from juice would be a winning combo. And this is exactly what you're doing. So I think that's going to be a massive hit with a huge audience. Even kids, so. Thank
you. And it's organic juice. So we do think that that's important as well. And because of the amount of juice that we use, it was incremental cost in order to have organic. So we did think that was important as well. But I agree with you. I think it's going to be more than just baby boomers and Gen Xers, and but we do have a base that remembers the brand, that will appreciate the pivot, because it's the same pivot that we are all doing in life.
Yeah, look. Yeah, I coach, kid sports teams, and even there, after a while, you even kind of go away from wanting the parents to bring snacks, because the snacks are so bad, after the kids run around for 45 minutes kicking the ball around. And so, yeah, I think stuff like this is, you're going to have a massive market, actually, because parents will even want that for their kids. So congrats on that idea. And I do remember the brand, back in the day. So that's a great case study of kind of revitalizing that brand, but you still take a big risk, because you know this better than me, but I don't think it's not like you could just launch that brand and immediately have an audience. There was a reason why, it was on the, you were able to pick it up for probably a reasonable price, and so you had to insert some magic to make this brand work. But I guess you would rather have a brand than, that had some existing appeal than, starting from scratch. That's kind of your plan there, right?
Yeah, and it's a good example of how important marketing is. So we partnered with a company here in Chicago called SRW. Great at what they do. Great at helping these emerging brands become bigger brands. They worked on Simple Mills here and Kite Hill and some brands that are becoming household names. And we're working with them, and they've kind of changed their model from just being a fee for service model to really wanting to be an equity partner in the brand. And we're thrilled to have them as part of the team. And we just understand how important it is that we retell the Slice story in a way that can really appeal to not only those that remember it, but to the millennials, to the new consumers, so they appreciate it for what it is.
Now, for these brands to succeed, as far as sales verticals go, are they? I wouldn't want to call it on the limited side. You have some direct to consumer ones, but in order to go big or scale, over say 25 million. Do you really have to work with a Kroger and a Whole Foods? Is that most of the time?
Yeah. So we, really the natural channel. And then we have great relationships with the distributors like KeHE and UNFI for the natural channel. And the natural channel when you look at it from, compared to conventional, it's very, very small, but it's a great brand building channel. So if you can make a brand work there, within our portfolio, it's a lot easier than to go to the more, the conventional, grocers and alternate channels of distribution, club, et cetera. But, the natural channel is a great way to build a brand and build those communities. And, it's one where most of our brands come from. The other group, we have a great relationship with with a lot of brokers, and we try to be not only distributor agnostic, but also broker agnostic. Presence Marketing is one of the leaders in the natural channel. We have a great relationship with them, and we have great relationships with other regional brokers and other brokers, throughout the country. We have a great relationship with a broker up in Canada. So those relationships are really, really vital. But I would say that most of our brands do start in the natural channel, and then we look for accounts to help us grow even bigger. But you can't really get to that $100 million level with the natural channel alone. You really have to start preparing these brands for conventional, and you have to look at price points and so forth to make them more saleable when you start talking to the Walmarts and the Targets and the Krogers and the Albertsons and Safeways of the world. So it's a challenge, but we've done a pretty good job preparing these companies for that migration over to more conventional.
And how are these companies thinking about profitability along the journey? So they're trying to scale to 100 million. It sounds like that's one of the numbers to hit, because then you become a better acquisition target. Are they having to maintain profitability, or are they picking up other investments along the way, after the Series A? And so it's more about building the brand and top line sales. What does that mix look like?
I will tell you, it really is dependent upon category. If I looked at Pacha soap, we invested in them when they were much smaller than they are today, but they were profitable. And it was mainly because the founder, who grew up on a farm, had this, desire to make his business profitable and cash flowing. We don't see a lot of that in the early stage world, but with Pacha, it was it's a wonderful story, wonderful founders, and they're in the middle of Nebraska, Hastings, Nebraska, where they're much more practical. And we actually, our first $1 million plus investment in Pacha was really to clean out the cap table. They had a lot of local investors that were more focused on things that generate distributions rather than seeing an early stage company grow. And so it wasn't until 4 or 5 months ago that we invested along with another fund in their first Series A. And so that's a company that's always been focused on cash flow. But when you look at these emerging brands, you have to spend money in marketing. And in certain categories, it's very, very difficult to actually, create profitable enterprises until you exit to the big companies that can, reduce the COGS significantly enough to make it all work. Beverage in particular, extremely challenging for small brands to make money because they don't have the DSD network. They don't manufacture themselves. They just don't control the things that ultimately reduce COGS. Look at, you'll like this business. It's called GEKS, GEKKS. We invested in them about a year ago, but it's a direct-to-consumer business. They do no Amazon business. It's all on their own website. They did, close to $5 million of revenue, direct-to-consumer. But they're inventing a product, and it's that education that's extremely difficult. It's an insert that goes into your shoe that's woven with silver, and because of that, it takes away the odor. And incredibly ingenious product that requires a tremendous amount of education, but they're currently not in any retail, traditional retail doors. But that company was profitable day one.
Yeah. Well, that's cool. I was, silver's a microbial side, so. That's interesting. That now, how come they're not on Amazon? Because the thing about, I get why brands don't. I totally understand why. But the thing is, Amazon's such a massive market. It's almost like they're forcing you to be on now because you can catch so many eyeballs and you can build a brand. then you got to deal with a billion knockoffs. But I wonder what's their decision not to be on there.
They will go there.
Yeah.
I think they were more concerned with generating positive cash flow. And unlike a lot of founders, they looked at, immediately, this was their, living. And so they pay themselves a decent wage. A lot of these founders, when you look at their financials and in their projections, they're waiting to have a base salary until years down the road, right?
Mm-hmm.
But if you look at most of these companies are, they're continuously trying to grow. And in the case of Gex, they just haven't figured out how to crack the Amazon code, and they didn't want to sacrifice margin. They do now, and they need someone like you to help them kind of figure that out.
Yeah, well, actually, they're probably going about it the better way. I can guarantee you that, because most companies do the opposite. They go to Amazon, they don't build their brand, and then I'm telling them to go build their website brand, get an email list, get your own your own customer, know how, create your community, all the things you talked about. So what they did is actually the much more difficult part. Going to Amazon is quite a bit easier when they've already built a legitimate business. But wow, that's love talk. I could talk about these businesses all day long, and thanks for sharing all of these ideas. But I think at this point, I think it would be great if you could share with the audience if there's maybe a big failure, maybe a really tough one that you've learned from, where maybe it improved yourself or your business.
Sure. Yeah, failures are they're inevitable most everyone's life. And for me, on the Dormitus Brands side, years ago I acquired from Unilever the Salon Selectives brand. Salon Selectives was really the first shampoo conditioner brand that customized your hair. So if you had straight hair, you got a certain number. If you had curly hair, you got a certain number, et cetera. And you mixed and matched sort of your hair type with the product. In its heyday, it was $400 or $500 million brand. Helene Curtis here in Chicago launched the brand, and then ultimately sold to Unilever, and then ultimately Salon Selectives was discontinued, and I acquired the brand directly from Unilever. My real mistake was, I brought in the old team from Helene Curtis, great, wonderful people, and I don't want to blame them for the failure because they did everything they could possibly do to make it successful, and they did a great job getting it to a point in a much more traditional CPG way. We had incredible products. We had, I think we were the best new product on the market back in 2008, and then the market failed. Our bank went out of business. We were stuck with no line of credit, and then I put my restructuring hat on, and ultimately, had to figure out how to save that business, and it was an incredibly stressful time in my life, and the brand without any financial support, we had put millions of dollars of equity into the business. Really, really challenging, and back in 2008, the financial markets weren't what they used to be, and liquidity was scarce, and debt was even scarcer, and ultimately ended up, finding a way to get all of our money back. But frankly, it was an incredible learning experience, and I didn't end up owning the brand that I thought we were going to create into a category leader. And but it was a failure that taught me about resilience and taught me that I still had the ability to kind of think out of the box, and ultimately, saved that the brand and still exists today. But it wasn't what we had initially invested in. But if I looked at it from a business standpoint, it was my greatest failure. But I learned a tremendous amount from that business, and I don't think I would ever spend for traditional advertising anymore. We were buying commercials and doing everything the big companies do, but when you're an early stage company, you have to act that way. And so part of the problem was we were building it like it was still owned by Unilever. And my greatest learning from that experience is you still have to be gritty. You have to be incredibly frugal with how you spend your money, and you have to measure every dollar you spend with an ROI, and don't pay people a lot of money to do it.
That is a great lesson right there. Measure every dollar you spend. No, I love it. That's a great way to kind of, wrap this up. And it's been a great discussion and talking about so many brands. How can folks get a hold of you? I'm sure, there might be some brands listening here that want to get in touch with you. Is there LinkedIn or website, or where should we send those folks?
Yeah, LinkedIn. I give anyone and everyone 15 minutes of my time. It's a policy that drives my partners crazy, but I feel that that's something that a lot of people don't do. And if entrepreneurs want to call and use me as a sounding board, or, I can't promise I'm going to call them back right away, but I do allow people to talk to me and give them guidance and so forth. The website's spiralsunventures.com. And my email is Mark with a K at spiralsunventures.com. Spiralsunventures.com.
Yep. And we'll have that in the show notes for the audience. So you can go over to retailband.com, and then the podcast will be there, and we'll have that down in the show notes. And wow, it's been a great discussion, Mark. I learned a lot. I took a bunch of notes here, actually. And might even have some follow-up email questions to you later on.
Great.
Yeah, I'm going to go look at Gex. I think that's like a really cool idea for a product brand. So I'm going to see what they're doing on their website. And you mentioned a lot of other cool companies, the soap brand. So very cool stuff here. I learned a lot. Thanks for sharing everything here. And also want to thank you all for listening to this episode of the Page One podcast, sponsored by Retail Band. And quick reminder that I'm offering a free evaluation of your online sales strategy. You take a look at your digital strategy on Amazon or Home Depot, Wayfair, or any of your other channels. We can see what type of selling tools you're utilizing. Also look at your influencer marketing strategy, or if you're not using one, see if it's a fit for you. If you're interested, find me on LinkedIn or email me at luke@retailband.com. And again, want to thank everybody for listening to the Page One podcast. All your reviews and comments are truly appreciated, and we'll see you on the next episode.
Thanks for listening to the Page One podcast with Luke Peters. If you like our show and want to know more, check out our other segments. Also, please help us out by leaving us a rating on iTunes. Want to learn more about our commerce? Check out www.retailband.com to get more great tips and tricks on how to accelerate your e-commerce sales with the big box retailers.